Hello and welcome, everyone. Thanks for tuning in. And I'm going to take a look at the week ending October 18th, 2024. Certainly appreciate, again, you tuning in. My name is Tom Bowley. I'm Chief Market Strategist here at earningsbeats.com, and want to go through a number of things. I'm going to show you a lot of charts today, and we're going to try to go through really quickly. But I did want to say last week, retail sales came out strong. That was probably the biggest news economically. Throughout the week, we came in better than expected, and as a result, we saw a lot of sellers of bonds with the yields moving up, challenging that 4.10 to 4.15% area of resistance. We'll see whether or not that level gets taken out this week. My guess would be that it'll bounce back to the downside, roll over, but we'll have to wait and see how this unfolds next week. Also, we had a ton of earnings. Earnings are starting to pick up. I didn't look to see an exact number, but if I was just guessing and eyeballing the numbers each day, I would say that probably about 80% of companies, maybe more, maybe 85% of companies have beaten estimates for the quarter. So it looks like earnings season has gotten off to a good start. Of course, many of the early companies that report are in the financial space, and we know the fourth quarter financials typically do well. We're getting a lot of really good reports in that area, and financials have broken out again. So that just kind of gives you a little bit of a backdrop, but I'm going to get into some more specifics now. So let's take a look at what happened last week. I've got a chart list that I like to keep the 11 sectors and then the six major indexes. So I'm talking about the Dow Jones, the S&P, the Russell 2000, the NASDAQ 100, mid caps, transports, those six, along with the 11 sectors like technology and consumer discretionary and so on. They're all in this list right here, and they're sorted in order of their weekly performance. So if you start off at the top, you see a lot of value, small caps, value, that sort of thing, utilities, real estate, financials. There's your IWM. That's the small cap index. Materials. You go down to the bottom of the group. First of all, you see energy. Crude oil prices dropped. Energy fell as well. Then we had healthcare not performing particularly well. There's technology, or that's the largest representation in the S&P 500. Technology underperformed, which of course led to the NASDAQ underperforming. Industrials, another aggressive area, not performing particularly well, at least on a relative basis. And there you can see that S&P 500. So from here, you can see what beat the S&P and what did not. But again, energy was rough. But I want to take a look at the three groups up here that actually beat. So let's pull up those charts. First, utilities. Utilities, I look at this and I see the pullback just below the 20-day moving average. We get this rebound back up to around the $82 level, which is our breakout. We got just above it, but then we failed. Then we tried to come back at the end of the week. We're right at key resistance, and I would call this a cup. So maybe we pull back to the $80 area, hit that 20-day, and potentially break out from there. That would be one pattern I certainly would look at. But the key here is we pulled back, we went back up to resistance, but we're struggling to break out. Real estate, very similar. We were at our peak back in mid-September, used the next 30 days or so to pull back, hit the 50-day moving average, and now here we come back up. Not quite a cup. We haven't gotten all the way back up to that 45 and a half level, but still pretty good action last week, getting up near resistance, but once again, unable really to make that breakout. Now let's look at financials. A little different picture here. Financials also went into a period of consolidation where it didn't break out above that previous high, which was set at the end of August. But look at what last week's action did for the XLF. Not only did we move up and have a strong week, but we did make a breakout, and it was very clear that it was a breakout. So we now have a triple top breakout, which provides pretty good support just below $46. So I'm going to call it right around $45.50 to $45.75. Notice the 20-day moving average, which now is at 46.08, rising up underneath price action. So I'm going to say right around 45.50 to about 46.08. That area is the key support on financials if we do see a pullback in the week ahead. And one thing we do have to mention is options just expired on Friday and didn't really have much of an impact on the market. I thought the market held up pretty well, even though there were a lot of in-the-money calls. I thought that it behooved market makers to move prices lower. They could have made a lot more money with prices falling. Didn't really see that, although technology, which is one of the areas that's most heavily involved in those options, a lot of trading of technology options. Technology did struggle, at least on a relative basis to the S&P 500, but still not really much outright selling. And I think, again, it just shows how resilient this bull market is. As we look ahead, we do have the worst week of the year historically. Doesn't guarantee us anything. I'm just pointing out the facts. Since 1950, the worst week of the calendar year historically on the S&P 500, dating back 75 years, is the October 21st close to the October 27th close. October 21st is Monday. So from the Monday close throughout the rest of the week, that represents the weakest week of the year. Again, I don't know if that means we're going to get a 5% correction or 5% pullback, maybe a 1% pullback. Maybe the market keeps going higher, seems to keep going higher no matter what. I'm just pointing out that it is the weakest week of the year. And so we'll see what happens. But it's reason to remain a little bit cautious. But I keep talking about caution, 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 and yet the market keeps going higher. It happens sometimes. I think the market's going to continue to go higher in Q4. Personally, I wouldn't mind seeing a little bit of a pullback next week just to relieve some of the oscillators before we head into what is the strongest period of the year historically. All right, I want to show you a couple RRG charts because small caps have been doing pretty well. I wanted to show you, this was back on July 8th, and this is where the IWM stood relative to the S&P 500. So I'm using the S&P as a benchmark, and I'm only showing the IWM relative to the S&P 500. So at that point in time, back July 8th, the IWM on a relative basis was extremely weak on a relative basis because this is relative strength right here. So left side of this chart is relative weakness. Right side would be relative strength. And then the top part, if you're looking up and down, that's momentum. So if you're up here in the top half, then you've got strong momentum. If you're in the bottom half, you have weak momentum. So as of July 8th, the IWM had weak relative strength and it had weak momentum. And then what happened? We had the June CPI report come out on July 11th. Remember that? I want to show you where the IWM is today. This is where we are right now, going back, and these are just the last 5 weeks. That's what these tails are. Just kind of shows you the path. Maybe the path of destruction or the path of construction, whatever you happen to be looking at. But in this case, IWM now has been leading. We did pull back over the last couple of weeks in terms of relative strength, moving back toward the left a little bit, but we still are right about the center point in terms of both relative strength and momentum. And this is where a lot of times we'll get some renewed strength and some renewed momentum. So that's interesting to watch. And I want to show you now that you've seen where we were and where we are, how we got there. So I'm going to just drag this right here. This is actually like a time capsule. And we can kind of go through, and as I drag this time from left to right, getting closer and closer to the current date, you can follow what the IWM was doing on a relative basis. So check this out. Just as we go through the rest of the last, couple months, maybe 3 months, check this out. Look at the strength that we have seen in the IWM. And now this is where we are coming down and then starting to maybe make another turn right here to go back out to the right. We'll see. Maybe I'd like to see it shoot right back up to the upside. We'll see. But my point here is that since July 8th, we have seen some really nice outperformance by small caps. And even though we've kind of pulled back a little bit in the last 2 or 3 weeks, that relative strength and momentum is still there. And I suspect that we're going to see a pretty good fourth quarter out of the balance of fourth quarter out of small caps. The other thing I wanted to show you was the IWM versus the S&P 500 from a seasonality perspective. And I go back 12 years. So down here on the bottom, let me just pull this up so you can see a little bit better. So the last 12 years, which takes us back to 2013, that's throughout this entire secular bull market that we've seen. The 2 best relative months for small caps relative to the S&P 500 are November and December in terms of returns, average returns. These 2 months, November averages outperforming by 1 percentage point on the IWM, December 0.6%. So add them together, 1.6%. You look at all the other months. We had February, which is positive. May and June were positive, but only to the tune of 1% combined. And the rest are negative or flat. So throughout this bull market, the IWM generally has not performed as well as the S&P 500. But November and December back to back are the two best months consecutively. So just want to point out that we're historically going into a period where the IWM has outperformed. And I showed you the relative chart with the RRG, where we've been seeing strength as we move throughout, from earlier in the summer through, today. And so that combination, and then also the IWM, I'll show you in just a couple of minutes. I'll show you a chart of the IWM where we actually made a really nice breakout recently, this past week. But first, I wanted to also show you an RRG of the sectors relative to the spider, relative to the S&P 500. And you can see there's only one group that is moving from improving into lagging. You want to move in northeast direction. That's kind of what the whole thing is about the RRG. When you start to underperform, you start to lose momentum. You drop down here, you start to lose relative strength. You go back over here, you start to pick up momentum, and then you pick up relative strength. And that's the cycle that you tend to go through. And look where financials are right now. Very, very steady climb on a relative basis up into the leading quadrant. Right now, it is the only one in the leading quadrant. What's down in the lagging quadrant? Well, we've got real estate right there. We've got discretionary, which has just moved into lagging. You've got utilities, which just moved into lagging, and materials, which also have just moved into lagging. Now, as far as groups that have shown very weak relative strength, you would have to go over here first and look at the real estate group. Definitely can see that. How about healthcare? It's starting to improve, but it's way left. It's way left of this vertical center line. That tells us that relative strength in healthcare has not been very good. Staples. So what you've got over here, real estate, staples, and healthcare. These are three of the four defensive groups that are underperforming by a wide margin. If we were getting ready to go into a market where we were going to tank in the fourth quarter, money would be rotating into those groups, not out of them. So that's just further indication to me, further proof that this market isn't done. We're going higher. Just a matter of how much higher and whether or not whether we pause before we go higher. But based on where we are right now, I had said earlier this year, if we had a significant pullback in the summer, then I thought maybe 6,000 was probably going to be out of the question for the fourth quarter. But we haven't really had that pullback. We had a quick drop back at the beginning of August. But other than that, market's been going higher, and we're poised, in my opinion, to go through 6,000 in the fourth quarter. But again, this next week, we'll see whether or not history plays a role. But we do have, like I said, the worst week of the year historically coming up. All right, taking a look at the major indices. First, we got the Dow Jones. Beautiful move up, bouncing off the rising 20-day moving average. I see nothing really wrong here. S&P 500, same thing, moving up, bouncing off the 20-day, going to new highs. PPO looks like it's back up to where it was. Maybe, I can't tell if it's slightly higher, slightly lower, but really not much of a divergence, negative divergence, if there is one at all. Nope, didn't want to do that. Let's go on to the IWM. Here's the IWM. Here's that breakout. So the breakout that I was talking about on the IWM, see that triple top, actually almost quadruple top breakout? That's pretty key. We still have a little bit more to do overhead. I'll show you a 5-year weekly chart real quick. But here was that top from back in November of 2021 before the cyclical bear market. So we had that cyclical bear market, and the IWM small caps have just been much slower to recover from that, mostly because interest rates have remained high. But now we're in an environment where interest rates are on the decline again. I showed you the relative strength of the IWM since early July. Now we're getting price breakouts in the short term. 235 is the key level to watch. Actually, I think it's 234 and change on the IWM. If we start printing 235 or above, we're in all-time high territory. So that's something certainly to watch for in the fourth quarter. IWM, I believe, is going to make that breakout. Transports. Look at the transports all of a sudden come into life after all these tops failed. Now we made the break. We're going back down, but I would watch this rising 20-day moving average because sometimes you get the breakout above price resistance. You pull back, you lose price support. Price resistance becomes price support. So if you pull back and you lose that, just watch the 20-day because if we're trending higher, that 20-day moving average is key support in a new uptrend. So that'll be an important area of the market to watch again in the upcoming week. All right, I want to talk a little bit about sentiment. VIX, the VIX finally coming back down. The VIX was kind of entrenched above that 20 level, and I don't know if it's quite over yet because, again, next week, not a great week. If we start to see a little selling, you might see that VIX pop back up one more time above the 20 level. But I do think the VIX has established a pretty key resistance level now up at around that 23, 23 and a half level. So I think as long as we stay below it over the course of the next week and a half, I think that brings us into a much more bullish period of the year, and I think we go higher. But watch that double top on the VIX. Next is the equity-only put-call ratio. I mean, honestly, this 5-day moving average has been screaming for a little bit of selling. When the 5-day moving average gets low like this, like here, we had a top here, had a little minor top here, ended up having a top here, not really too much. Here, we had a top for a little bit. This one, maybe a little bit of a pullback, not much. But if you go back and look historically, there have been a number of these that have set up significant tops when you see so much complacency in the options world. So now that we've kind of come back down here, we did pull back for a day, but again, we really just haven't seen like a 4, 5, 6-day period where we pull back 2, 3, 4% and kind of unwind our overbought oscillators in the market. So this is still a possibility. You just need to be aware. I always look at this and generally I'm going to be a little bit more cautious when the short term, when everybody's buying calls relative to puts. That normally is a signal that maybe the masses are going to get it wrong in the near term. So far, though, market continues to move higher. And again, I think that speaks to the resiliency of the market. All right, let's take a look at some of the earnings that came out. Now, one of my favorite trades during earnings season, I look for it all the time. And I actually mentioned this one on my Tuesday show, Trading Places Live, that UNH was getting beaten up after its earnings. Now, UNH, going into its earnings, was a relative leader in the healthcare providers area. You can see that the relative strength of UNH relative to healthcare had been climbing for about 6 months, sitting at a 52-week high going into earnings. They beat on their top line, they beat on their bottom line, and the stock sold off. So it was one of those cases of buy on rumor, sell on news. But a lot of times the news, when you get that sell on news, when you've got a leader that just beat top and bottom line, pullbacks generally create a really nice opportunity. Sometimes in the very near term, you might get that gap down and then the buying resumes immediately. Sometimes you go down for a few days and then start to turn back to the upside. But either way, these are stocks that I really like to focus on in my trading. So I ended up buying UNH as soon as the show ended. I actually got in just a little bit higher than I wanted to. But this stock went up from in the 540s to up near 570 that day. And if we take a look at the 5-day 10-minute chart, you'll see exactly what I mean. So here it went down. I think I ended up getting in I think I did pretty well here because I think I ended up getting in just below 550 and ended up selling when it went up and then came back down and lost the support. So I didn't hold it, but I think we're going to see the stock continue to climb personally. I just traded it, took profits and got out, but it's one of my favorite types of trades. So I want to show you a couple of others just like it. Fifth Third Bancorp, another one. Look at the banks, or look at the stock relative to the banks. In September, near the end of its fourth quarter, or near the end of its third quarter, I should say, it was showing tremendous relative strength. And then it kept going higher, but it was losing a little bit of relative strength because banks were going up faster than FITB. Anyway, fast forward, Fifth Third Bancorp reports its earnings. They beat top line. They beat bottom line. I think they raised guidance as well. The stock gapped up temporarily and then saw a big sell-off. So this one on a 5-day, 10-minute chart looks like this. So as it was going down, I just watched it and watched it as long as it kept putting in those lower highs. Well, here we started to put in a higher high. I've talked about this many times. I talk about a lot in our trading room. If you're not already a member, we do these live trading rooms every Wednesday at 10 a.m. Make sure you come in, check it out. I think you'd really enjoy it. And again, we have a 30-day free trial. So you come into the next 5 weekly live trading rooms and get a better flavor for how we like to trade. But earnings season is my favorite time to trade. This is one of my strategies. Get a good stock, great relative strength, comes out with great numbers, and then the stock sells off. Great time, in my opinion, to think about trading it in the short term. Anyway, FITB, you can see a great reaction there and a move back, which was awesome. The next one, American Express, another one. Look at the relative strength. Very strong. They came out with their numbers. They beat top line. They beat bottom line. The stock went down to the 20-day moving average. Another great opportunity for profits. Here it was. There's your morning weakness. And then look what the stock did coming back later in the day. So those were 3 fairly easy, low-stress trades that made money if you were following relative strength, making sure they beat top and bottom line, and then getting a sell-off, get that sell-off on the news. Sometimes, like I said, it doesn't always work out this beautifully. Sometimes you have to give it a day or a couple of days, maybe even a week, and then it'll start turning back to the upside. So you might get stopped out on some of these trades from time to time, but that's going to happen in any trading strategy. But overall, I really like to play these or trade these stocks that show excellent relative strength, post great results, and then for whatever reason, sell off after their earnings. Now, let's take a look at Netflix. Netflix went into its earnings. I mean, just recently, again, in September, 52-week high relative to its peers, pulled back a little bit into the end of its quarter, stayed a little bit, down, kind of, you can see selling off a little bit right before the earnings report. But I was on record here saying I thought Netflix was going to have a big report. They actually, I think their numbers, I don't remember if it was a guidance number that came in a little weaker than expected. But anyway, the stock gapped up, cleared the recent price high, and closed strongly, and did so. I'm not showing the volume here, but it was a big volume day on Netflix as well. So really good report, good reaction there. Intuitive Surgical was another one. Look at the relative strength. All year long has been going up, up, up. Kind of went sideways here into the end of its quarter. Went sideways in terms of relative strength, just like Netflix pulled back a little bit and then exploded with its earnings. So if you're going to have a couple takeaways here, one would be when a stock has been a leader and then pulls back into its earnings report, if there's one trade that I would consider buying into and owning before the earnings report comes out, it would be similar to this, where you've got a leader that's already pulled back some before earnings come out. The flip side is following stocks that are leading and are at or near highs and then report great results and then sell off. That would be another strategy that I like to follow. But let's keep going. I want to finish the show off with the Mag 7. Just to give you an update on where they are. You can see Apple trying to make this big breakout right around the 235, 236 level, showing relative strength. I expect a good report out of Apple when they come out. I think you're going to see some good numbers. Microsoft, this one worries me a little bit. Now, if you look at it from just purely from an absolute price standpoint, you've got equal lows down here around 390, just below. You've got your high established at 470. We're sideways consolidating, which isn't bad, except that it's trailing its overall group, and it's gone down to a 52-week low relative to its group. I don't know if Microsoft's going to come out with bad news, but I don't think that it's going to have blistering good news based on the way it's trading. So I'd be a little bit careful with Microsoft going into earnings. NVIDIA, I think NVIDIA is probably going to have another blowout report. We're right back up to that 140 level. Finally, took a long time. Once the semiconductors topped back in June, it's been a difficult road. Back, down, up, but we haven't gotten back above that June 22nd high. NVIDIA is right on the threshold. However, NVIDIA doesn't report until about the 3rd week of November. So I don't know if we'll get the breakout before earnings. If we do, that would be great. But it is showing great relative strength. So NVIDIA, no doubt in my mind, is going to have a good report. Whether or not it carries the stock to new highs, we'll have to wait and see. Meta. This is probably my favorite internet stock. So Meta's been breaking out, continues to trade very well. Look at its relative strength. It's really, in this last quarter, picked up significantly. It's back up near its all-time high. I suspect we're going to get a good report out of Meta. Amazon, kind of middle of the road. So we've been kind of going sideways here, showing a little bit of relative strength over the last couple months. But overall, the entire quarter was downtrending. So I would just be maybe a little careful ahead of the Amazon report as well. Google, not a fan at all. Just has not traded well relative to the market, has not traded well relative to its internet peers. And I just don't think they're going to have great news. Maybe I'm wrong. Maybe they're hiding something from Wall Street, but it doesn't look great on the chart. And then finally, Tesla. Tesla's actually been building on a relative basis versus the autos. It did have the recent gap down when they came out with their robo-taxi day or event that they had recently, and they didn't impress investors. But notice, all it was a gap down. Do you see any major selling after that? I don't. I see just sideways action. So I wouldn't be surprised. I mean, Tesla's kind of sideways as well, kind of trading in a range, hasn't broken out. But I would say this one looks better to me than something like Microsoft, where Microsoft has gone down and trading at a 52-week relative low versus its software peers. That's not the case here with Tesla. So the group itself hasn't been great. And Tesla, over the course of the last 6 months or so, has been a leader. So Tesla, I'm kind of on the fence on. I think Tesla may surprise to the upside. We'll see. Anyway, last thing I want to do is I want to walk you over to our website at Earnings Beats. If you go to Earnings Beats, no, both those words are plural, by the way, earningsbeats.com. Scroll down. We have a free newsletter, completely free. No credit card required. You can unsubscribe at any time. It won't hurt my feelings. I simply put these charts together to try to give you something, try to give you the things or talk about the things that are important to us in trading. I think they'll help. I think we try to make them educational. But they come out on Monday and Wednesday morning, usually talking about relative strength. A lot of what I talked about today, relative strength and weakness, talk about gaps, earnings gaps, and how you trade them. Can talk about oscillators, trend lines, moving averages. I mean, all the typical stuff. But anyway, check that out and sign up. I think you'll really enjoy it. And again, it only comes out a couple times a week. It's a very short read. So Monday and Wednesday, you'll get a chart with a couple paragraphs. But I think it'll help. I think you'll enjoy it. So make sure you subscribe. If you're on a mobile device, we have a slide on the screen now with a QR code. All you have to do is scan that QR code, and it'll take you to a landing page where you can sign up for the EB Digest. I can tell you that on Monday, I'm going to provide you a chart of one of the companies that's going to be reporting this week that I think looks really, really strong on a relative basis. So you might want to check this one out. But again, just sign up. Either go over to our website, earningsbeats.com, scroll down and sign up in the area provided, or use your mobile device, scan the QR code, and come on in and join us on the EB Digest. Love to have you. Anyway, that's my report for this week. Let's see what happens in the week ahead. Again, historically, not a great week. So we do have to keep that in mind. But the market's been incredibly resilient. Maybe it just keeps on chugging. Have a great weekend and enjoy your week ahead. And we'll do it again next weekend. Have a great day, everybody. Happy trading.